Welcome back to the channel, PulseChainu Tribe. In this video, I'm going to talk about liquidity farms and which ones might potentially be good opportunities, at least in my eyes. And stick around till the end of the video because I'm going to tell you which liquidity pairs that I personally have been experimenting with. Experimenting, right? Not going all in. And I'm going to tell you which liquidity pairs as well that I'm interested in providing liquidity for in the near future. Not right now, but I'm waiting for my opportunity to strike. But I realize that there's a lot of new people in the ecosystem, so I want to go back to the basics on liquidity providing and just, in a nutshell, really try to provide in the simplest way I can the basics of liquidity farms and what they are and what is liquidity providing, okay? You'll often hear the acronym LP. That just stands for liquidity providing, okay? So I like to LP with a small percentage of my stack personally, and again, it's only as an experiment. I'm fully admitting that I might potentially lose money in all of this, okay, with something called impermanent loss. But I've chosen, personally, the experiments that I want to run in the liquidity farms that I want to run as well. Now, you can get a visual on what a liquidity farm is if you just go over to pulsex.com, app.pulsex.com, click on the liquidity tab, add liquidity, and basically you're pairing any coin with any other coin. And this goes into what's called a liquidity pool. All right, so with a decentralized exchange, there's no one person putting up all the liquidity for other people to trade in and out of. It's crowdsourced, okay? So on a centralized exchange, the company, let's say, for example, puts up a bunch of US dollars and a bunch of PulseChain on both sides of the equation, and that lets the retail investor like you go buy PulseChain from their reserves of PulseChain using USD, or it lets you sell PulseChain into USD, for example, using their private reserves that may or may not exist, and it's really, really scammy, okay? So a DEX, a decentralized exchange, is a better way. Just think of it like you're crowdsourcing the liquidity, like you're letting other people trade using your money along with everybody else's, okay? Now with PulseX, you have to put up an even amount of dollar value in liquidity on both sides of the equation. The numbers are a little bit off right now just because, the oracles aren't quite right. Just ignore that for now. Those will stabilize over time. But for example, if I wanted to put up 1 million PLS tokens, I'd have to put up a relatively equal value of PulseX tokens in terms of the ratio, right? I'd have to put up 2,700,000 PulseX tokens because you have to put an equal number of tokens on each side according to the current ratio. Now, I go over constant product market in a previous video. It's a bit technical, but if you want to learn more, I do have an old video about this, okay? It's pretty good to get an understanding of it, but all you need to know is that this is where you provide liquidity. Once you do that, you'll be issued a PLP token that will go to your wallet that will represent your stake in the liquidity pool. It'll basically represent how much trading fees you earn. So why do people want to provide liquidity, right? It's so that they earn passive income in the form of trading fees, okay? So let's say you've got this much tokens in the pool and somebody goes to buy PulseX using PLS. Well, they have to pay a very tiny 0.3% fee in whatever token they're paying with. So if somebody's paying in PLS to get PulseX, they have to pay a tiny 0.3% fee to the liquidity providers, okay? And that 0.3% fee of that 0.3%, 0.22%, okay? So about 70% of the fees is divvied up proportionally to all of the liquidity providers. The other 0.08% goes to the buy and burn, okay? Fun fact, the other 0.08%, or actually 0.07% technically, goes to buying and burning the price of PulseX. So that's hugely bullish for PulseX, but that's kind of beside the point right now. It's attractive to be a liquidity provider because you capture a portion of the 0.22% of fees being generated both in PLS and in PulseX. So it goes the same for the reverse too. If somebody buys Pulse using PulseX, they have to pay a very small fee in PulseX terms, and all those fees coming from the hundreds and thousands of people worldwide get divvied up proportionally. 0.22% of all those transactions gets divvied up to all of the liquidity providers, and you get, X number of coins based on your share of the liquidity pool, right? And your share of the liquidity pool is what your PLP tokens represent. It's just a way for the computer to do the math to figure out how much fees you get in terms of both PulseX and Pulse. So if you have your money locked up in for example, a PulseX liquidity pair, you're going to earn fees in the form of both tokens. You're going to earn PLS fees when people buy PulseX using PLS, and you're going to earn PulseX fees when people buy Pulse using PulseX. Okay, that's the bare bones basics. That's as simple as I can make it for you. And again, think about it like you're letting other people trade using your money. It's your money plus everyone else's money because we're all pooling it together in a liquidity pool. All right. What did I just say? You're letting other people trade using your money. You're sacrificing your own money in order to make fees and potentially INC token, right? But you're letting other people trade in and out of the tokens that they want, and you are kind of the house. You are the casino. You are a small fraction of the casino. Everybody combined that's putting up liquidity is the house that's providing all of the coins for people to buy and sell or to swap for each other. Now, if you're going to be a liquidity provider, you need to know that in order to avoid impermanent loss, you want to choose pairs with high volume and low volatility. What is high volume and low volatility? Well, hypothetically, you would want a pair that people are trading all day long in and out of multiple times a day, and there's tons of transactions going on because remember, every transaction generates a transaction fee that gets divvied up to you, little by little. But you'd want low volatility, which means theoretically you'd want the coins, the ratio between the coins in this pair to be stable, flat line, zero. There's just a flat line. Now that never happens in reality, but you could think of a stablecoin pair, for example. What does the chart of USDC to USDT look like? Well, it looks like more or less one, just flat one, tiny little deviations. But, because people are swapping USDT for USDC all day long, but they're both worth $1 because they're stablecoins, right? So that's kind of the ideal lowest risk liquidity pair that you can have. So as an example of a pair with high volume and low volatility, really the only example we have that is kind of a perfect match with these two qualities are stablecoin pairs. And let's say we're looking at the hex-EHEX chart. Well, when we look at the ratio between these two coins, we want to see kind of stable flatlining here, okay? The EHEX-HEX chart is a pretty good example of what we like to see. Lots of volume. Look at these volume bars on the bottom. That indicates that lots of people are trading in and out, but the price is relatively stable. The ratio is maintaining between about 1 and maybe 1.3. So that looks pretty good, and it's only getting more stable. That's why I find this particular pair attractive. We're going to get into that in a minute. Stick around. Hold on. Now, you want these two qualities, high volume and low volatility, because that's what's going to avoid what's called impermanent loss. There's always the risk of impermanent loss. There's always the risk that when you pull your coins out of the liquidity position, 1 month later, 2 months later, 1 year later, there's always the risk that you're going to end up with more of the less expensive coin and less of the more expensive coin. What do I mean by that? Let's say you put up liquidity on Hex USDC, right? And Hex is a penny at the time, and USDC is $1, right? Then let's say everybody goes crazy and rushes to buy Hex, and they buy Hex up to 50 cents, okay? That happened in the last bull market. It really happened. Now Hex is worth 50 cents, but you're left with less Hex in the pool because everybody bought Hex and gave you US dollars in return. They bought your Hex, and they gave you dollars. So yes, you have more US dollars, but you have less Hex, and you missed out on a coin that went up 50x. Does that make sense? So let's say you put up 1 million Hex and, $1,000. You might pull out $1,100, but you might only be left with 700,000 Hex. And at that point, when Hex is 50 cents, don't you wish you would have had that million Hex rather than giving away 300,000 Hex and only getting a tiny little USD reward? So that's impermanent loss, right? Because again, letting people trade using your money, if you have a coin on a pair that everyone's rushing to get rid of one coin and go into the other coin, that's bad because you're going to end up with more of the coin that nobody wants and less of the coin that everybody wanted. All right? It's as simple as I can make it. Again, you get PLP tokens in your wallet once you provide liquidity, and that you can look at that like your receipt of the fact that you have liquidity in the pool. And the PLP just acts as a method to calculate how many fees you get as a reward in terms of, again, both of the tokens in that liquidity pair. Now, if we go one step farther, we can stake those PLP tokens in liquidity farms. Again, that looks like these over here, the liquidity farms, right? And it's not every pair, it's only these farms. But you can take your PLPs, stake them in here, connect your wallet, and start earning INC, today if you wanted to. And that's the gist of it. That's liquidity providing. Those are the risks. And guys, typically, if you're starting out with only $1,000 or a couple $1,000, the fees you're going to make are going to be negligible. You know, you're putting yourself at risk for making what, like $10 worth of fees or $100 worth of fees. It's when people start to have, you know, $100,000 or $500,000. That's when you start to see the fees adding up to be, you know, a couple hundred, couple $1,000s. All right. So don't expect to just get rich on this, especially if you're a holder with lower dollar values, and you might just want to sit this out altogether. That's going to be one of the morals of this video, is that you don't have to participate in liquidity farms. And if you're a smaller holder, the juice might not be worth the squeeze. All right. You might end up with a lot less of a coin that's worth a lot more, or you might have just wasted your time in the sense that, you know, all the fees that you get total might only add up to like, you know, 20, 30 bucks, when really you could have just held both coins and just watched the price rise on both coins together and not subjected yourself to having, you know, any impermanent loss at all. Because really, if the impermanent loss isn't offset by the amount of fees that you make, you're not going to be profitable. If you're not making more fees to make up for any impermanent loss, again, I'm going to say that one more time. If you're not making enough fees to make up for any impermanent loss, you're going to have a bad time, and you probably shouldn't have been a liquidity provider in the first place, okay? Now, that said, if you want to do this, some of the strategies I'm looking at are, well, there's 4 different things. There's 4 different kind of categories that I look at when classifying liquidity pairs, okay? First one is something I already talked about, stablecoin pairs. These are safe. These are boring. And they're boring and safe because, again, it's the only situation where you do have high volume, you know, people swapping one stable for another stable, and you have low volatility because typically they're either worth $0.99999 or $1.00001, right? So you're not having a lot of volatility and you're having a lot of volume, but you're probably not going to make crazy fees, again, unless you have like $100,000 or more to be putting into these stablecoin pairs, okay? So it's safe and boring, but the fees are also kind of low, but it is safe and boring. So to do with that what you will, right? I'm interested in this potentially later on. I don't have any stablecoin pairs right now. That's because I don't see any that already exist, and I don't like to be the guinea pig on anything. Personally, if I don't see a liquidity pair already made, I'm not going to be the first guy to create the pair. Basically, that's what I'm saying. But if I go to dexscreener.com one day and I see a USDC DAI pair and it's got a bunch of liquidity, yeah, maybe I would consider doing a stablecoin pair. What's next? Well, these 3, this is called the trifecta, the Richard Heart ecosystem trifecta. PulseX, Hex PulseX, and then Hex PLS, okay? If you're going to provide liquidity on these, what you're gambling on, what I'm gambling on, is that the liquidity is bound within a range, okay? Remember that I said you wanted liquidity to be low volatility? Well, let's take a look at the PulseX Pulse pair, all right? And we got to switch the price. We got to click this button up here to get the real ratio, because what Dex Screener automatically shows you is the dollar value. All right, a lot of people might be confused about that. Dex Screener will automatically calculate the USD value because that's what most people care about. But with liquidity ratios, you want to click this button here, switch to price in PLS. Always click this button when comparing the actual ratio. This button in the top right corner. Click it. Now you have the ratio, right? The ratio here looks a little bit funky because it's going pretty high right now. And quite honestly, I don't want it to go much higher because I have a position in PulseX. In this liquidity pair, I made a position. But what you want to see is you want to hope that, you know, the liquidity pair stays between a range, something like this. And you're going to want to hope and pray that it just kind of bounces around in between back and forth over time. Because, again, like I said earlier, if one coin becomes extremely overvalued relative to another coin, well, then I'm stuck with a bunch of impermanent loss. So I'm taking a gamble here that I'm betting on the fact that the ratio between PulseX and Pulse won't go between maybe 0.23 and maybe 0.4. Okay, I'm hoping. It might not. I might lose money. Okay, but typically also, guys, you want to be in these liquidity pairs for a longer period of time to really start to see the results. It's not like you're just going to get in here and start making money and get rich overnight. Not even in a week, not even in a month. Guys, I'm talking like 6 months, 8 months, maybe a year. Typically, the people that actually win in liquidity providing have longer term liquidity plays. Now, there are times where that's not true. There's tricky things you can do to get in and get out. This video is not about that. This video is about picking a safe pair that you think is safe. And you might not think this pair is safe. You know, I'm taking a gamble and I'm explaining the gamble that I took. I'm hoping that the ratio stays range bound in between a relative range, and it might not, okay? But I also plan on holding this liquidity position for a pretty long time, for a matter of many, many months, not days, okay? Hopefully at least 2, 3, 4 months. Now again, if I see the price really running away from me, if I see it breaking out of a range and going extremely high, then I'll get scared and I'll probably pull my liquidity out. But I don't want to see that, and I don't think that's really going to happen, personally. Just my opinion, I could be wrong. So I personally have an experiment going on in the PulseX liquidity pool because I believe that the ratios, like I said, will be range bound in something like this. Okay, it might be a little wider. That might not be perfect. I just drew random lines, okay, on this chart. But this is also true if you start to see Hex PulseX or Hex PLS. I picked these coins because they're all Richard Heart ecosystem coins. Like, these pairs are all self-referential to each other. Let's take a look at Hex PLS, right? And again, remember, we have to switch to the ratio by clicking this button in the top right. We don't want the USD value. And look at this one, guys. This actually looks a little bit better than the other pair that I actually provided liquidity for. This one seems to be pretty range bound right now. Look, we've got roughly prices fluctuating between 70 and 140 PLS per hex, okay? And that actually looks kind of good, kind of safe. I'm just thinking out loud here. I might actually have to strongly consider liquidity providing for this pool, because as of right now, and again, guys, it's only been a week, okay? We can't draw any conclusions yet. It's only been a week. But if this continues to be range bound, then that would look attractive to me. So that's why I just highlighted these 3 pairs, is because they're the popular pairs on PulseChain. They're the Richard Heart coins, and it's where all the attention is really at, especially right now in these days. Another strategy you can do with liquidity providing is ERC20, PRC20 pairs, pairing your Ethereum version of your coin with your PulseChain copy of your coin. So for those that don't know, with PulseChain Network, it was a full system state copy, meaning that if you had any ERC20 coins, let's say you had Chainlink over on Ethereum, well, you now have an identical clone copy on the PulseChain Network. It does the exact same thing, same smart contract, but it just lives native to the PulseChain Network. Now, this is confusing for a lot of people. It's even confusing for me sometimes. You just have to deal with the fact that we now live in a world where every coin on Ethereum has a clone, a copy, a PulseChain version, a doppelganger on the PulseChain Network. But what people are doing, especially with the EHEX hex pair, is they're choosing to bridge in their EHEX from Ethereum into PulseChain, and they're choosing to bridge it in and pair it to native PulseChain hex. Where is that pair? Here it is. Look, this is one of the top liquidity pairs already with 17 million USD value in liquidity. And the more liquidity you can provide on PRC20, ERC20 pairs, and EHEX hex is paving the way. It's the perfect example. It's basically the guinea pig, right? It's case number 1 for how this is actually going to work. And it's all very experimental, but I personally am interested in providing liquidity on this pair because I think that it's going to be stable, but with high volume. I think the prices are going to be pretty stable with high volume. I might be wrong, okay? People could choose to value the PulseChain version of Hex way more than the Ethereum version of Hex. I don't know what's going to happen. Neither does anybody else. But let's drill into this, right? Remember, again, click this button in the top right corner to get the real ratio. Guys, that looks pretty flat to me, does it not? And really one of the main reasons I haven't provided liquidity for this pair yet is because, well, I don't have any liquid hex right now. Guys, all my hex is actually staked right now. I'm waiting for a stake of mine to come out. I think it's in a couple weeks. And then I'm going to reassess the situation. But to me, guys, the situation's looking pretty good. Remember what I said. You want a lot of volume. Look at those volume bars. You want low volatility. Look at how flat that is right there. Now, if this continues for maybe another 2 weeks, maybe a month, and after the bridge clears, then I'm going to strongly consider bridging in some Ethereum and backing it 1-for-1 with Hex. Hopefully it's at a 1-for-1 ratio. I don't know what the ratio will be. I just hope that the ratio is stable. So 2 things need to happen, right? I need to see more stability, more time, right, before I make my decision. I need actual liquid Hex, so I need my stakes to actually run out. I need one of my stakes to end so that I actually have liquid Hex. And then 3 things, okay? I also need to see the bridge working again. Because right now, guys, if I try to bridge my EHEX, it's not going to be available for like another week probably. I want the bridge to be fully functional. I want the ratio to be stagnant. And I need my stake to end. Okay, so that's really all I'm waiting for on this. But I'm attracted to this liquidity pair because I believe that it will have, again, what do we want? High volume, low volatility. I believe this might continue to happen, that this trend might continue to happen. I would love to see that. And you could theoretically do this with any ERC-PRC20 pair. You could do this with Shiba and eShiba. I don't care what you do, but that's just one of the strategies here with liquidity providing. One of the new strategies that PulseChain's introduced that we've never seen before, right? Very, very cool, this strategy right here. And finally, guys, this last strategy is an accumulation strategy. So if there's a coin you want, and you're a guy with a lot of money, let's say you have a lot of a stable coin, and you want to buy, let's say, PLS. But you don't just want to market buy it, because that might push the price up against you too much. Maybe you'll suffer from some slippage fees. Well, if this is concerning to you, if you're trying to buy, let's say, a lot of a particular coin, let's say you want to buy PLS and you have a lot of DAI, well, as a proxy for actually buying the coin, instead of actually buying the coin, you could just pair it on liquidity, right? And then that way, when other people choose to sell PLS for DAI, they'll be taking some of your DAI and giving you some of their PLS, and you make a trading fee. So it's almost theoretically like you're getting paid to buy the coin that you want. So in the situation where you want to buy, let's say, PLS, any PRC20, and you want to put up a stable coin and liquidity bond it, well, that's a good way to accumulate. If I put up $10,000 and X amount of PLS, but I want more PLS, well, this is a good way for anybody that wants to sell their PLS to just go ahead and take from my DAI pool. And guess what? You get to pay me a fee in addition. And guess what? I also get INC token on top of that, right? So this is a very advanced strategy for people that already have the coin that they like. They already have a stable coin. They just want more of the coin that they like, right? So, and they're assuming that a lot of people are going to want to sell some of that coin too. All these strategies are very interesting to me. I'm not doing this last one. I'm doing this one potentially when the time is right. And I'm doing a very humble experiment on the PulseX pair. And to be honest, another thing I'm doing that's not listed here is all the INC that I'm accruing from this PulseX pair. I'm actually funneling all that INC back into this pool down here, INC PLS. And that's just because I don't care if I get impermanent loss on this. I don't care if I end up with more INC or more PLS. You know, I don't care which one becomes more popular. Right now, as it stands, personally, I'm comfortable holding either coin, INC or PLS. So I'm taking the risk of impermanent loss here just because I don't care if I end up with less PLS or less INC, and I don't know what's going to happen. But this is the recent development in my experiment. Again, I'm taking the INC that I'm earning from PulseX pair on liquidity, and I'm funneling that back in, and I'm earning INC on my INC. It's kind of crazy, I know. But I hope this made sense to you guys. Those are a couple of liquidity bonding strategies. Don't feel like you have to do any of this, okay? Again, it's for larger players, stronger hands, and 9 times out of 10, you're better off just buying the coins you like and just sitting on your hands and watching the price go up, you know, after maybe a year or two. All right, so take it easy, guys. I hope you learned something. Like, subscribe, leave a comment, share the video, help make this go viral, and pump your own bags. And I'll see you on the next video.